Okay, so we've looked at what liquidity is, and then we started to look at how, we can identify where we assume resting liquidity is on the chart, or where, liquidity was and has already been swept and taken. Okay, so now we're going to start to get into the more sort of juicy side of things, where we are going to look at, how we actually use these liquidity concepts within our trade plan and how to formulate trade ideas and all that good stuff. So like I was saying before, first we're going to kind of have to strip things down into their individual pieces, into the individual components, so we just know how to identify them and what each individual component, how we interpret it. And then as we go out through the lessons, then we're going to put those all together to, put the pieces of the puzzle together right. And we're going to get a bit, fancy, and then perhaps a little bit lost in the sauce with entry models and all that good stuff. So it's good to just take our time, build things up slowly, and we'll get there. So yeah, and like I kind of touched on there, it can be very easy with all of this, and not just liquidity concepts, but the whole strategy in general. There can be a lot of variables, a lot of components, right? And it can be very lost to kind of, or very easy to get lost in all the source of it. So what I always try and do is trying to bring things back to a high level and ask ourselves is, what are we trying to do here? What is kind of the overarching philosophy of the strategy and the trade plan? And for me, what I think I'm at least doing, or what the philosophy is behind my trading approach, is to look for institutional footprints in the market. Okay, so where was the big money involvement? It's a bit of an oversimplification when I say the big money involvement, but it's just an easy way, I think, to kind of hold on to what it is we're trying to do here, right? We're trying to look for where the big guys got involved. I want to be trading with them rather than against them, quote unquote. So the first kind of way we've been doing that, specifically with sort of looking where they've entered, is looking at supply and demand zones, but not just any supply and demand zone. We want to look for where did big money enter or exit the market to cause those overwhelming imbalances in the market, right? So to significantly move price. How do we do that? Well, we filter those supply and demand zones by looking at ones that either broke structure, right? Because obviously it takes a significant amount of money to break structure. The more significant the structure, the more significant potentially that zone is going to be, or it managed to flip another strong zone, right? Where we see that interaction between supply and demand, and one manages to overpower the other, right? Where one takes control, okay? So when we've been identifying that, that can hopefully signal that there was institutional backing in the creation of that zone, okay? So liquidity concepts, they're simply just another great filter to signal BFI involvement, okay? BFI, banks, financial institutions, right? It's just another acronym in the space that's already overloaded with acronyms, but basically the big guys, right? Institutional involvement is what we're saying there. So it's just another way in which we can now apply these liquidity concepts to what we've already been looking at as another sort of tick in the box. Let's say that potentially there was big money involved in that area, okay? So now just bringing a step back to what we're talking about in the theory lesson, right? Every buy order must have an equivalent sell order for a trade to take place, okay? So obviously, like I said, if you need to buy 10 apples at $2, you need someone selling that minimum amount of apples. Someone needs to be selling at least 10 apples for $2, right? Otherwise, there can be no trade taking place, okay? So if you're a large market participant, right, you're going to need the equal and opposing liquidity to enter the market with minimal slippage, okay? So essentially what that means is, well, if you think about the order book, right, at every single price level, there's going to be, orders, right, supply and demand. And if you're in a market where, say, there isn't a lot of supply and demand and it's a bit of liquid, like you've got loads at list level, not much here, another chunk here, and then loads up here. If you're someone down here, right, and you're a big guy, let's say, and you want to buy 10,000 lots, what's going to happen? It's going to quickly absorb all of that supply, and you're probably going to get filled some of your order up here, okay? So large market participants, they need opposing liquidity to enter the market with minimal slippage, right? If you want to buy here with a ton of volume, you want a ton of volume to be exactly where you want to buy. You want a ton of volume to be selling to you that you can buy from, right? So you can transact at this level rather than getting filled all the way up here. That's essentially it. So when we are identifying where liquidity has already been taken, okay, so that's why we're looking on the price charts and we're going, okay, there was probably, if you got a low like this, right, there was probably liquidity below that low. If we see where price then comes down and grabs the liquidity below that low, that's what we say grabs, liquidity has been taken, liquidity has been swept, liquidity has been run. They all essentially mean the same thing, that price has come in and grabbed some of those orders there. So when we say it's been taken in the past, and it leads to the creation of a supply and demand zone. That is what we call a sweep zone, okay? And that signals where BFIs have likely entered the market, right? And this is where we kind of get some of these patterns like this, okay? So essentially, we are looking for, in the creation of, well, let me bring it back again. When we look at supply and demand zone, like I said, right, we're just looking at one structure zones, ones that lead to a break of structure. Now, all we're simply doing is when we identify a zone, we validate it because it did break structure. Okay, so we know it's an institutional zone and it's an institutional structure zone. The only extra filter we're now looking for is we look left of the zone and we go, did it sweep any liquidity, right? And it swept the liquidity behind that high. So now we call it a sweep zone, okay? Because if you think about it, if an institution is selling here, right, and they're selling or they're shorting enough, right, to lead price to be able to break a low, that's what we identified, that potentially there was a lot of supply that came into the market, so then we can look to try and get short here, right? So we use the filter of it breaking structure. Now, like I said, for every buy order must have an equivalent sell order, okay? So if you're someone who wants to sell, a ton of volume up here, what do you need? You need someone buying, right, from you selling into. You need a lot of people buying up here. And what do we know about highs? We know there's a lot of buy-side liquidity above highs where people are either buying the breakout of a high or the breakout of a bull flag, or what's the other way? They could be having their stop loss behind the high, right? If they're short and price comes back up, what's their stop loss going to be? It's going to be a buy order, right? If you've sold your position and you're short, if you get stopped out, what do you need to do? You need to buy back your position. So essentially what we know is behind highs, there are tons of buy side liquidity, okay? There's lots of buy orders there. So if you're a big guy and you want to short and you want to sell, what do you need? You need that buy side liquidity. So it's likely you're going to enter short up here, selling into all of that buy side liquidity so you can get as much of your position filled as possible. And then that move leads to an overwhelming imbalance that causes a break of structure, okay? So it's just another filter that potentially signals there was institutional involvement in the creation of this supply zone because it led to a break of structure and it grabbed the liquidity or used the liquidity in order to enter the market, okay? That's the theory behind what we're doing here, okay? So yeah, essentially liquidity, identifying where liquidity has been taken in the creation of a sweep zone signals where potentially they have likely entered the market. And where liquidity is resting, okay, so liquidity that hasn't yet been tapped into behind here. We'll talk about this later, but essentially that's the concept of inducement, and we can signal where they will likely in the future potentially enter the market, okay? So a sweep zone is a POI that sweeps liquidity as it is created, and we assume that it's likely there was institutional involvement in the creation of the POI as they grabbed the resting liquidity to enter the market, right? So another quick few examples. Well, a point I want to make is how much, I think I alluded to this before, but how much liquidity is behind this high? We never really know, right? But we can look at certain structures and assume that some may have more than others. So if you think about this high here, right? If you've got a bullish market like this, what did this high achieve? It didn't achieve much, right? It didn't break any structure. It's just a weak high that had a pullback. So arguably there's not as much liquidity behind this high compared to what we have over here, right? Because what do we have here? We have price pullback, breaks the high, right? So this low did its job, right? It broke structure. So you could assume that because this low actually achieved something, it broke structure, there should be quite a decent amount of liquidity behind it. So now if price breaks that low there, right? You would assume there's even a ton more liquidity behind here now because it actually achieved, it broke a strong low. So now when price comes back up and sweeps liquidity behind here, the sweep of a strong high, so a high that actually achieved something, compared to the sweep of a high that didn't achieve anything, we can assume there'd be a lot more liquidity building up behind this high. So if you see a zone like this where it sweeps strong structure, strong high or low, right? So you've got this low breaks the high, that then becomes a strong low. If price now comes down and grabs the sell side liquidity below that low, we can assume that this, in theory, this zone should be stronger than this zone, right? If everything else was the same, of course you have to bring in market structure, multi-time frame analysis and all that fun stuff. But if you just had two identical zones, but the only difference was this, in theory, this should be the stronger zone because it's used likely more liquidity behind that strong high. And then likewise, same here. If we have a build-up of equal highs, we know there's going to be a lot more liquidity starting to build up behind there compared to if you just had, one weak high like that, okay? And that's pretty much it. You don't need to overcomplicate sweep zones any more than that. Kind of just a little sort of FAQ here. For me, for a sweep zone to be valid, it does not have to sweep strong structure, okay? So that's a weak low, right? If you have a trending market, it never broke the high, so that's a weak low. It doesn't have to sweep it, but this is obviously more ideal, right? Because this sweeps strong structure. So I would view this as higher probability than this, but it doesn't have to be. I would still view that as a sweep zone. Okay, and the other thing is the sweep must be vertically near the POI. So what I mean by that is like if you say you had a pullback like here, and then price comes all the way down, and then price comes all the way up and breaks this high, okay, that is a valid demand zone, right? That broke this high here. But can we say that it swept the liquidity behind this low? Well, it's miles away from me, right? So like, you know, it's probably used liquidity all the way down here. So I wouldn't say that that's a sweep zone of this level, okay? It needs to be pretty near it. Now, the other thing as well that I forgot to mention is sort of when we look at this on the candlestick charts, it'll become a bit more obvious, but sweeps usually kind of, they have what I call the nature of price action. So what you'll typically see is price will kind of come up, it'll sort of be a bit slow, and then it'll kind of just grab the liquidity behind that high, and you'll usually see like a big wick and then like a sharp movement down, okay? It's kind of like slow movement up, and then boom, like the big money steps in. And usually you'll just see kind of like a big wick like that, a big wick retrace, or you maybe see like kind of one or maybe two candles close and then like boom. So it's kind of like that obvious sort of, you know, sweeping nature that you get to it, okay? So yeah, that's it with structural sweep zones, and we'll take a bit of a look at these on the charts to identify them. So 20-second recap on what a sweep zone is. It's essentially another filter that we are using that potentially indicates that a supply or demand zone was created by institutional involvement, big money involvement, because the theory is that they've likely used the available sell side liquidity below that low to enter their long positions that then leads to that break of structure, or likewise using the buy side liquidity above those highs to use as liquidity to enter their short positions to enter the market. Okay, so let's go and look at what these look like on an actual chart. Did get some requests to look at pairs other than euro dollar, which is fair enough, right? Just to show you, how these concepts are universal and can be applied to any instrument or asset class. So let's kind of just zoom in to the recent PA price action. And what we're going to do is, like I said before, at this stage of this module, we're just going to be focusing on identifying and sort of defining those individual concepts on their own. So I'm just going to look at some examples of sweep zones. We'll talk a little bit about how it's developing with price action, but for the most part, I'm not going to be getting too stuck into how we're analyzing everything together with all of the concepts and thinking about trade ideas and forecasting where price is going to go. We'll leave that for a little bit later in the module. For now, I don't want all of these lessons to turn into 30 or 40 minute walkthroughs. I just want us to get good at identifying them, and then towards the end, right, we'll put it all together and we'll spend a lot more time kind of really walking through price slowly and using bar replay and all that fun stuff. So what we'll do is we'll kind of go from here and we'll go through sort of recent price examples to where we are. Now, one thing I'll say as well, we'll just zoom out on probably to the weekly chart on pound dollar, that when you get these sort of major breaks of monthly and weekly lows, right? And we can see that price ends up having these big pullbacks up towards a strong high. And then again, we get another big, massive, basically break of that low, and you get these sharp movements. Very often the sort of nearest structural high can be quite far away when you're trading down here. So like, for instance, it might be a bit more clear on the daily, like the last real sort of clear swing pullback is all the way up there. So for all of this time when price is trading here, yes, you can look at that as your strong daily high, but typically what I would advise is just kind of focus on the more recent price action and like follow this, just because you've got such a massive swing range that, if you're trying to short every supply here, a lot of times, price is just going to react. It's just a catalyst for a pullback, right, to push up higher. Again, we'll talk about this a lot more when we come to internal and external range liquidity, but just because when I go through this, it will make a bit more sense as to why I'm going to start mapping structure, right, looking from within here, even though, yes, I know that the last swing high is probably all the way up here. When you get these big, massive sell-offs, sweep of the low, I'm basically going to start mapping my internal structure from here and just focusing on this, because otherwise if you're just waiting to short from all of these supply zones, a lot of the time you are going to get smashed. So we kind of look down here and just start mapping that internal structure on the 4-hour chart. And we can see we had this break here. Now, what happened when we led to that break? Obviously, we have demand zones that came in to lead to that break of structure. But what do you notice? We have price come down, it pulls back up, right? And then it grabs the liquidity below that low, right? We get a sweep of liquidity, and then that fuels the move there to the upside. So let's just draw these on. Okay, and then it's quite a big candle, so it's a bit of a messy zone, but essentially you get that large sell to buy candle with the next candle closing above it, right? Price taps into that, and then that leads to the move that then breaks structure. And then even on a smaller scale here, you see what happens. Price comes in, it pulls back, it breaks the high, right? So we know there'll be liquidity below that low. And what does price do? It comes down, grabs the liquidity, and fuels the next move to the upside. So you have another sweep zone there. Okay. Bit of a tricky one this to draw, because sometimes when you get kind of price action like that, I kind of like to include the wick as well, and I kind of just take that whole range. We get a bit of a reaction, but ultimately it ends up failing, and we come a little bit lower. We end up tapping into the previous internal demand range here, as we can see, and then we continue there to the upside. But as we pull back, all right, so at this point, this would be your sort of larger internal high that you'll be focusing on at that time. What happens when we form the strong low? Well, as you can see, as we're pulling back, get that fractal structure, this low breaks the high. Okay, so we know that that becomes somewhat of a strong low because it actually broke some structure this low here. So we know that would be a fair amount of liquidity building below that low, sell side liquidity, right? Enticing early buyers into the market. Price then comes down, grabs that liquidity, and now it has the fuel to make that big move, right? So the theory would be that that low gets put into the market, enticing early buyers into the market, generating more sell side liquidity. And now let's say the big guys can step in and they can use that sell side liquidity to enter their long positions. And now there's enough juice to fuel that movement to the upside. Okay, so we get another sweep zone here where we sweep the lows there. And then we move to the upside. And as we can see within that overall move, we also get a flip. So we get the reaction from supply, and we can refine that to the pivot candle in which price comes down to, right? That's where demand really regained control from supply, and we move there to the upside. And even you can see here, right back here, when this initial sweep happens, then we flip, and then we come up, we have a bit of a pullback, and we go higher. And what happens? That generates more liquidity below that strong low, right? That broke that high, and then price comes down. We get even more equal lows here, right? Another bounce, just enticing more market participants into the market, generating more sell side liquidity. And then we get that liquidation into the flip here. And then now we have the fuel to make that movement to the upside, right? So you just get another big sweep POI here, right? And then eventually that leads to the move that breaks structure to the upside. And then again, we come down to this strong low here. So hopefully you can start to see a bit of a common theme when the pro sort of trend moves, pro order flow moves. Very often those strong lows when we're bullish will form through a sweep of liquidity. Okay, so like, I don't know why that disappeared. I must have moved or deleted it, but there, we initially had that sweep here, right? So very often what you'll see is price will move to the upside. You kind of get those corrective low resistance highs. Price will come down, and then as it's sort of starting to make that what we think is going to be the higher low, very often price will come down, then grab the liquidity, and now we have the fuel to the upside, and then we get the breaker structure. And then likewise, we sort of get those corrective moves down. All right, we might build some equals, and then we'll get a sweep of those potentially into the sweep POI here at the previous strong low. And then we'll have the fuel, right, as we liquidate those lows to get to the upside, right? And those low resistance highs there, that basically leaves liquidity to target, available liquidity to target at the high. And then same cycle repeats, right? We'll come down. Obviously, it can all happen in slightly different ways. You get a break of the high there, generate strong liquidity below that low. We come into the previous sweep zone, and then we go. So that's why, you know, when you've got sort of descending highs like that haven't swept any liquidity, that's where we say there's resting available liquidity above those highs there. It's low resistance. So when price is coming up, it's easy for price to target those highs, right? There's liquidity to target. But when price is pulling back down into our strong structural low, this is where we have, you know, that sort of high resistance liquidity low that formed, it swept liquidity. It's got strong demand zones that took liquidity that led to the breaker structure. And that's why, you know, we have those protected ranges, and very often price won't break it, and we'll continue to the upside and target those that low resistance available liquidity at the top, right? So you can see kind of what I'm saying here is we come up, we pull back, sweep liquidity, strong movement to the upside, right? Again, we have that pullback, get that low there, sweep liquidity, and then eventually we go, come up, generate more liquidity, sweep the liquidity, and then we go. And that will happen, you know, even on a smaller scale. Like when we come into this low down here, right, that sweep POI that swept the liquidity below that low, we initially tap into it. It's a bit of a tricky one to see on this time frame, but we come in, what do? We move to the upside, and then price comes down, and it just grabs liquidity just below that low. It just breaks it by a few pips, right? And now the movement is ready to go, and you get another sweep zone created there. Now this one's even a bit more subtle to see. Do we flip this range? Yeah, we do. So we come into the supply, but what happens if you look at how those candles would have formed, right? Price reacts, it comes down, it pulls up, and then what does it do? It comes down and grabs the liquidity below that low. Yes, it's just a weak low, right? It didn't break any structure on this time frame, but remember for sweep zones, we don't need it to sweep strong structure. It can sweep a low like that, and for me, that's still valid. I find it higher probability, and I prefer it when it sweeps a low that actually, clearly broke structure, and even with the candle body close, like that's brilliant when that happens. And you can see when price came back, super strong reaction. Okay, but for me, this still meets the criteria, and this is a flip that swept liquidity. So yeah, spoiler alert for the next lesson coming up, but this is a perfect example of that, right? So we had the reaction from supply, we pushed the upside, but what did the reaction do? It swept liquidity, okay? It came down, it came up, grabbed the liquidity below that low. So the theory is, right, it signals more institutional involvement using the liquidity that would have been available below that low to enter their long positions to then overpower supply and continue the movement. So what do you have? You have a flip that swept liquidity, okay? So now obviously you can draw your flip from the top of the reaction to the bottom of the reaction, which we come back into. Of course, you can refine it to the pivot zone as well. And again, rinse and repeat, right? What do we have? We try and take out the high at that point, right? That would be your range high. Zoom out a little bit, right? You can see the bullish structure forming overall, right? You can see this larger internal structure. We pull back, larger range here, right? So that would have been your low. Okay, so there was always potential, right? Price might have wanted to come down and mitigate something within that wick. But if you actually look, right, that's where liquidity was taken. That's where you had that true kind of last interaction between supply and demand. Then we got the sweep of all of this liquidity here, right? So we're following the money. That was the last big injection of demand. So although price could have come down to the strong low, there's pretty good reason to believe why this might be the next POI where the next swing low is going to form, right? To come to the upside. So we can look for 4-hour continuations within here, right? We can look on the lower time frames and try and get involved. And then we get that next interaction here that sweeps liquidity. So we know there's probably going to be somewhat of a, a protected low within that range. And then again, what happens? Entices early buyers into the market. They get liquidated. And then we come into that last level there and then we go. Okay. So, this is somewhat of a sweet POI again. It's a little bit far away. It's kind of what I was saying, right? In terms of, so if I draw it on first, to say whether or not, you can classify this particular POI I'm drawing on now as an actual sweep zone, because obviously, I'd like it to be pretty near like that. But yeah, it meets, the general criteria, right? There was liquidity below there. Liquidity was potentially used in line with this demand, right? Using all of that sell side liquidity to enter long positions here to buy against those sellers to then generate that movement there to the upside. And obviously when, trending markets are strong, they're not always going to pull all the way back. Do we have any sweep zones in here? Let's have a look. So price comes in, we pull up, right? And then we come down. So we grab the liquidity below that low and that fuels the movement there to the upside. Okay, so hopefully you can sort of see with your eyes now, what we're looking for. Some are obviously a lot more, let's say, significant than others, right? When we have like the big liquidations back here, following the demand chain into the flip, well priced, right? We can start to add in a lot more stuff, but kind of just at this point, like I said, just trying to like sort of identify the bare minimum definition of what one is. This one's a bit messy to sort of draw, right? But you do have, that's kind of being the cleanest zone. Price won't always come in and kind of perfectly mitigate that. Sometimes when you get sort of, quote unquote messy price action like this, I will obviously draw it on the nice refined pivot range like that. And I did, it's super nice when price perfectly mitigates that, but sometimes you can kind of read between the lines a little bit and like, I'd want to cover that wick. Some of you may even potentially want to take the larger range, right? But obviously as price pushes into the zone, you can refine it a little bit and then look on the lower time frames for your confirmations. And again, another sweep of that low as we came in to that POI, right? Now this movement here fails to break structure on this time frame. So this wouldn't, this here wouldn't be like a valid 4-hour POI, but you can still see the idea of what's happening here, right? It swept that low, demand came into the market, and we've come off it, okay? Let's kind of move along a little bit. So, we just keep getting those larger breaks of structure, just following that bullish order flow. Okay, at this time we come into, I think this is a flip, so we have this level of demand here. Okay, didn't sweep any liquidity, so this is not what I would call a sweep POI because, let's have a look at it. All right, if you look at the fractal structure, we come up, we pull back, and then all of those candles break the previous candle's high, then we pull back, and then we go. Okay, so if you look at that, it's just an up movement, down movement, up movement, down movement, up movement. So we don't sweep any actual low. Like for there to be a sweep zone, it would have had to sweep that low there, right? It would have had to come down, grab that low and go. So it would have had to sweep this. If that had done that and gone like that, then I would call it a sweep zone. Because for me, or at least at the time of recording, I want to see like an actual, a minimum of like a fractal low that needs to be taken. Now, some people, they will look at like the wicks of the candles and they will say, price came down, grab the liquidity below that low there. And that's for them. Now on a lower time frame, that's probably what would happen, because on a lower time frame, how would that look? It would look like a down movement, an up movement, right? And then price is taking the low. On a lower time frame, you go down to maybe the 15-minute. But on this time frame, think about it the way that we look at fractal structure. What happened? All of those candles broke the previous candle's high, then we pull back, and then we went. So for me, there's no sweep on this time frame. But some people, when they're defining sweep zones, especially with flips as well, they will see that as a valid sweep, okay? So I'm not saying one is invalid or valid. I'm just saying the way I would recommend you guys do it when you're starting out is the way I'm saying now is you want to see it to be an actual low on this time frame, okay? So that would be the low that would have to get swept, because in theory that should be more significant, right? Because it's an actual structural low on this time frame, okay? So I would start with that as your starting point, and as you get more experienced, or you collect more data, but you're then happy to see a sweep zone like that, where you can see that on a lower time frame that would be a sweep. You may want to include that, okay? Because some people do that with their trading. But hopefully I made it clear. I'd recommend you start with the more conservative approach, which is wait for an actual low on this time frame to be swept. That would be sort of my recommendation. Let's speed this up a little bit, because I don't think this needs to be a super long video. But yeah, we'll just do a few more sort of obvious examples, right? Again, we pull back. What do? We mitigate that flip, right? So this is where we had that initial interaction from here. Okay, it's a little bit messy, but there we go. You can see where demand took control from supply, led to the break of structure, and we pull back. What do? We build some nice equal lows, okay? And then you see that's that aggressive nature that I was talking about. You kind of get that corrective, and then boom, big money is potentially using the sell side liquidity to enter their long positions to then generate the next move to the upside. And that's what I was saying at the start, right? You kind of get these move up, you get this sort of low resistance, right? All of that liquidity building up behind those highs because none of it's been really swept. I mean, there was a bit of a sweep in here. Okay, so that would be, and you can see, right, that POI gets respected because we come down, have a bit of a fractal pullback, grab the liquidity behind that high. So that would have been a potentially good, nice counter trend area to look to get involved on lower time frames, right? Price comes into that 4-hour POI, that swept liquidity, and then we can look for a quick counter trend play down into demand. Okay, but you see behind that, now you've got all of that available liquidity that's been untapped, and that's the liquidity to target. Okay, so typically, like I was trying to say there, is what you get is price will break structure, okay, like that, and then you get kind of usually these corrective moves, which we can trade to the downside, but it leaves that liquidity for us to target, and then price will generally come in, either form equal lows like this, sweep into the previous protected low, and then we get the movement, or like similar thing, corrective move down, and then we'll get like a low that breaks a high. That's the low that then gets swept, and then we go. That's very, very typically what will happen, and then that becomes a much more sort of protected low. Why? Because it signals that big money was involved in there, so they potentially have the intention to try and protect price trading below that low now. Again, what do we have? Price comes in, comes up, grabs liquidity below that low, and then we go, but eventually we end up sweeping that low, right? More equals, and then we go again, and then we get another break of structure. And then obviously at some point, right, you could be using multi-time frame analysis. We've probably come up into a big daily level, up and towards or sweeping these highs. There's probably like a daily POI up here, right? And we start to shift a bit of structure to the downside, okay? So not getting too much, like I said, into trade ideas. It's more just kind of generally spotting how these sweep zone forms and how ththose protected swing ranges form right below, as I've kind of gone over. And yeah, we end up actually, you can see, just on a bigger scale, we come into this low down here. We build some nice equals, enticing more traders into the market to generate more sell side liquidity below those lows. There we go, trying to draw the poorly drawn dollar sign, sweep that liquidity, and then we go, right, even on a scale there. So you've got a nice POI, sweep POI, strong movement there to the upside as all of that sell side liquidity is used, and then almost bring us to where we are. What do we have? See how it just keeps happening now. We come in, we come up, grab the liquidity below that low, then we get a break of structure here, and then this one happens quite quickly. It's probably news or something, but you can see as we break this high here, right? It happens almost in the next, basically straight away in the next candle, but you would have had, right, this breaks the high, so there would be decent liquidity below that low, and price literally comes down, grabs it, not by much, but you literally grabs the liquidity behind that high, and then fuels the next movement to the upside, right? So that was a super quick sweep of that low. After that low had already been swept there. And then we get another mini one here. So price comes down, pulls up, comes down, sweeps the liquidity below that low. Another break of structure to the upside. That then becomes your next sweep POI. Now with those sweep POIs, for like the ones where you get, so price comes in and then you get like a break of a high there, and then you sweep what we call like the strong low, right? That I love POIs that do that. They don't have to. Remember I said with sweep zones, it can just sweep weak structure. So you can also have the example where, let me zoom out a little bit. Okay, let me just go back here. It's easier to show. Here, right? So that's a sweep of a weak low. That's a sweep of a strong low, right? Actually broke structure. So both of those are valid. I just prefer one that sweeps strong structure because arguably more sell side or more liquidity, right, has built below that low to break that high. So in theory, that should be a better zone. So for that low to kind of what I would deem to be somewhat strong, like this low here, right? So we pull in, we come down, we come up, and that just breaks the high. So are we saying this is a strong low that then gets swept? I would prefer it to be one that actually does cause a body closure, okay? But wick break will take it. It's better than not having it. So we get a sweep at that level, come back into the sweep POI, and that would be a level there. And then that pretty much brings us to where we are. I don't know if there's any sort of more clean, obvious examples. But yeah, so hopefully you can kind of get the idea of just what we're looking for. I don't think it's anything too complicated. It's just what we usually do is we just look for those zones as we have been before that lead to a break of structure. You draw it on, you draw the analysis where market structure is it well priced? And then if you just want to ask yourself, is it a sweep zone? Just look left, and did it sweep any available nearby liquidity in the formation of that zone? And it can be another tick in the box as to why this should be an institutional zone and likely will be a protected low.